let me talk through the logic of what you should have done before I actually do the numbers myself. The annual cash flow is $2,000 a year. So you are paying the coupon rate on the nominal value. We will repay $2,000 a year. The net proceeds of issue, which is the initial recognition, is only going to be $95,000. There are no issue costs. So effectively, we're borrowing 95. Debit cash 95, credit liability 95. The cost of borrowing the money is 8%. So 8% on the 95 is your finance cost. You are then going to repay 2,000. So your key working is 95,000 plus 8% of 95,000 minus 2,000 will give you your closing liability. Yeah? So my key working is that I have an opening balance in year one, and my opening balance is 95,000. Because you initially recognize the liability at the net proceeds of issue at the fair value. Yeah, plus the transaction, less the issue cost. Now your P&L will be your finance cost, which is running at 8%. So 95,000 at 8% is giving you an expense of 7,600. The cash that you pay is the coupon rate. So the cash that you pay is the 2% on the 100,000, and you are not paying off any of the liability. So your liability is all non-current. Your liability is all non-current. So 95,000 plus 7,600 minus 2,000, that is giving me here a closing liability of 100,600. Back I go, my finance cost is 7,600, and my non-current liability is 107. Now it's relatively easy for me. If I'm given a blank sheet of paper, all I have to do is put in the right answer. If I'm given a blank sheet of paper, all I have to do is put in the right answer. But maybe in an exam context, the wrong figure is there. So maybe somebody has charged 2,000. Maybe somebody thinks the closing liability is 100,000. And you've got to make sure that you get the right expense and the right liability. I'm just pausing here for a second to make sure there aren't any questions or queries before we dig a little deeper. Something I would like to do, and we will be doing tomorrow, is the cash flow statement and the operating activities and the indirect method. What you do with your indirect method is you add back the non-cash expenses. So you add back depreciation, because depreciation has caused profit to come down, but you haven't paid it. This finance cost is a non-cash expense. You've debited the P&L with 7, and you've credited the liability with 7. So one of the things that you will always do in your cash flow is you will take your finance cost and you will add back your finance cost. One of the other things that you will do in a cash flow statement is to show cash flows. So one of the things you will do later is to show the amount of the interest paid. And how much interest have we physically paid? 2,000. So for me, you could get a question which asks you to explain about amortized cost, but you could be examined in isolation, or it could be part of a P&L question, or part of a balance sheet question, or part of a cash flow question. But amortized cost is the regular way to go. Amortized cost, liabilities, going. In the classification of financial liabilities, I have amortized cost as number 1. And I have here, yeah, fair value through profit and loss account liabilities as number 2. Now I have to say, first of all, this is unusual. If I own PPE, PPE operates under a mixed measurement system. So under PPE, sometimes our assets are at cost and sometimes our assets are at fair value. So we do have a mixed measurement system for assets. It's also possible for us to have a mixed measurement system with liabilities. Sometimes liabilities are at cost, sometimes they're at fair value. It's unusual. Yeah, your default is amortized cost. What sorts of circumstances would you have fair value through P&L? Well, one might be trading. So if you're trading with liabilities, this would give you a fair value through P&L. If we have something which is known as the fair value option, then it would be at fair value through P&L. And if we're giving a guarantee, that would also be fair value through P&L. Now, if you've got a fair value through, and we'll look at these in turn. If you've got a fair value through profit and loss, the initial recognition is at fair value. So initial measurement is fair value. In other words, issue costs are expense. In other words, issue costs are expensed straight away. And at the year end, you revalue to fair value. Year end, you revalue to fair value. I was brought up in England, and as a child, my parents would take us on holiday every year to the neighbouring country of France. So we'd get the boat across and we would go camping in France. And when I was 18, 19, I took my first holiday without my parents, and I got on an aeroplane and I went to the Mediterranean and I went to a country called Greece, which is very beautiful, got very beautiful beaches, blue sea, white buildings, beautiful place. What do you know about Greece? What do you know about the country Greece? Sorry? Recession. Yeah, I thought you might say the Olympics. Yeah? But yes, the recession. In terms of Greece, one of the most famous things about Greece at the moment, and has been for the last generation, last 10 years, is their financial crisis and the fact that the Germans and the other Europeans get involved in bailing them out. Let's imagine I am Greece and I am borrowing money. So I issue a loan and I borrow money from you. You lend me the money. So I borrow 100 million, I have a liability of 100 million, and you have an asset of 100 million. Now what happens to Greece is that we keep on thinking that Greece is going to go bust. So you lend me the money in good days. You lend me the money when my credit rating is fine. You have an asset. I want you to think about your asset. All right? You've lent 100 million to Greece. Greece is now going into financial meltdown, financial difficulty. What happens to the value of your asset? Does the value of your asset go up or down? Down. You suffer a loss. I have an increased credit risk. There is a risk that I'm going bust. So the value of your asset goes 100, 90, 80, 70, it starts to tumble. So you therefore are incurring losses. Now think about me. I'm Greece. I've borrowed 100 million. And I'm thinking of having that liability at fair value. If my credit risk goes up, if I become dodgy, if I become at risk of failure, then the fair value of my liability goes 100, 90, 80, 70, 60. And does that give me a gain or a loss? It gives me a gain. So if I have issued a liability and I have it at fair value through P&L and my credit risk gets worse, then I have a profit, which is a little bit loopy. You cannot recognize that profit in profit. It would not make sense to be able to increase your earnings because your credit risk had gone up. So where do you think the changes in value due to the changes in credit risk should go? If they're not going to P&L, they should go to OCI, correct? So we have a revalue to fair value. Changes in fair value due to changes in credit risk of the issuer are taken to equity, are taken to equity, are taken to OCI, are taken to equity, are taken to OCI, not recycled, and other changes to P&L. I do find it a very unfortunate name because we say it's fair value through P&L, and we shouldn't really call it fair value through P&L. We should say it's fair value through P&L brackets, fair value through OCI if it is down to changes in the credit risk. So let me just recap. In terms of financial liabilities, we are classifying two types of financial liabilities, amortized cost, and we are classifying the other type of financial liability as fair value through P&L. Let me just conclude, and then we'll do some examples. Reclassification is basically prohibited. So reclassification is prohibited. So we're not allowed to switch once you've made that. And derecognition, if we want to talk about derecognition of financial liabilities, derecognition is when they are extinguished. Derecognition is when they are extinguished. Extinguished means that they are discharged. They are cancelled. Yeah? They lapse, they expire. Yeah? And so that gives you the life cycle of the financial liability from initial recognition and classification. You cannot reclassify a financial liability, and a liability is derecognized when it is extinguished. That's the language of the standard. We need to have a look at a question which is then going to draw out some deeper understanding of the application of the fair value through P&L. Now this question is called 3 lions, and this question is following on from horse. So this question is called 3 lions. That's what I'm about to ask you. So this question is called 3 lions. And immediately follows on from horse. In terms of the page number, It is on page 144. Page number. It is on page 144.